they can outperform the market. So like, what do they usually perform? Like they can beat 8 to 12%. They can beat like, they can go 15%, 20%, or.
Well, everything's relative, right? Depending on, what again, I'll just use, if a mutual fund's doing 6, you probably can do better than a mutual fund.
Okay, right. When you say better, like 7%, 8%, or like not guaranteed, but like is there an average or a range, or?
There isn't really a range, right? It could be by marginal, but if the advisor or the manager makes the right tweaks and certain categories outperform significantly, it could be 2-3% more. But the point of it is that they have to be very tactical. They have to adjust the portfolio, and then they have to really do their research and know what they're doing.
So is it like typical investment advisors, if they're good, they can usually generate 15% return or something like that? Or is it not like...
That's not the case.
Oh, it's like case by case.
It's case by case because different investment advisors, again, not all of them have the CFA designation. Their investment styles are different than others. Some use products. Some manage the portfolios themselves. So it really depends on like who you're dealing with, and these are some of the questions you need to ask when you're looking at an advisor. So what's your style? What tools do you use? What happens in certain situations, right? Because we're all different. It's kind of like realtors. Like you all call realtors, but you all have a different niche. You all have a different style of approaching things, and you specialize in different markets. Same idea. We're all called advisors, but the tools we use, the style we do is very different from one another.
I'm guessing like a lot of people would go to investment advisors and just be like, hey, I want 20% return. Like, can you do it? And you're like, no, I'm not sure, or whatever. And then they go to the next one or something like that. Do you see that, or like?
It's mostly relationship based, right? I mean, after 2008, people were less greedy. I mean, before 2008, people kind of were like you, like, hey, can you do 20%? No, I'll go to the next guy. Now it's kind of the opposite. It's like, well, how do I make money but still control my risk?
Okay.
Right, so it's kind of like whoever can control the risk the best gets the client.
Because what I heard is that like really good investors, they don't lose money or lose very little.
That's
like,
right.
They don't necessarily it's not about making the biggest gains. It's about not losing money.
Well, that's what I'm saying. If you protect the money properly, you survive, you live another day to see tomorrow.
Yeah.
Right? So if I can protect the principal, I sell my bullets, I can invest it. If I lose 20%, now I gotta make up
to that 20%.
Well, exactly, right?
Which is not just like, they say like, if you lose 20%, it's not just like making 20% to make up for it. You have to like double.
Pretty much. If you do the math, losing 20%, you need to probably make about 30+% to make up for that loss. And then you start making money. Right? So that's what I'm saying. Like the whole corporate spiel, if you go to a bank and they say, hey, long-term hold, go through the ups and downs. We all know there's cycles. We all know that there is. If we all know there's cycles, then why aren't you, as an advisor, doing tweaks to the portfolio to minimize the losses? Right? Because if I can minimize my losses, then I don't have to like make up for it and then start making money, right? So there's that difference.